5% is your prediction of GDP growth, down from 5.2. Why is that?
Yeah, we looked at our key variables that we look at to predict the GDP, and we thought we would notch it down a little bit by 20 basis points. Two main reasons. One is the export sector is not doing as great as we thought it would do, mainly because of the eurozone crisis. So it's not doing badly, it's just that it's prudent to at least recognize the fact that the eurozone crisis continues. While it's not getting worse, it's not getting better as fast as we thought it would get better. Then the second issue is that while the rate environment continues to come down, it's not coming down as fast as we thought. So that still continues to slow down the economy a little bit. It's not negative growth, it's still positive growth, not just as much as we thought. So we thought we would notch it down a little bit by 20 basis points.
Well, 5% growth in South Africa we can only dream of. So perhaps you're a bit disappointed, but it's still a good growth. I'm interested in the comment you make about credit risk being a significant challenge. I would have thought with interest rates at 18%, as we heard earlier, credit risk is always going to be a problem, unless the perception is that they're going to come down. What's the relationship between that and your prediction?
Yeah, what we are talking about in terms of credit risk is when we did our quarterly review this time around, in addition to focusing on the macro and the GDP, we also focused a lot more on the banking sector, which is a big sector in this country and really in sub-Saharan Africa. The financial services is a huge part of overall GDP. So with rates as high as they are, we wanted to see what has that done to the loan books of banks as they reported Q1. A couple of the tier 1 banks have reported, one of the tier 2 banks have reported. And what we found interesting is that while the rate environment continues to be elevated, the non-performing loan book actually went down, and you've not seen the kind of defaults that you would expect to see in this kind of rate environment. And we attribute that to a couple of factors. One is quality of management of the banks. I recently have attended one investor briefing for one of the major banks, and you look at the quality of management, how good they know the business. That is one factor that helps. And if you go down a little bit, from the quality of management, you look at credit risk management. I think the credit risk management in this country has improved a lot over the last 10 to 15 years when we used to have bank defaults. So those are the two factors that we attribute to the anomaly, whereas you should have expected increased defaults, you actually saw decreasing defaults in a high rate environment.
The Monetary Policy Committee meeting today, and do they have a mandate to look after growth as well as the currency? And what is the relationship between their statements and GDP?
I view, and based on what I know, I'm no economist, but I view their primary role to be price stability. And if you look at what people are predicting, I think the speaker before this, I had somebody talk about 8 out of 10 predict them to hold constant. Our view is that they will hold constant, but we would not be overly surprised if they decided to reduce. The main reason why we think they would hold constant is because the inflation rate, while it has come down, it's still significantly above what they've considered the level for price stability, which is 9%. So I still view them as, while they're concerned about growth, the key issue is going to be price stability.
What's your view on what they're going to say?
My view is that they will say that while the inflation rate is coming down, while the money markets, you can see interest rates are coming down, the core inflation rate, food, non-alcoholic beverage, and then the other key component of inflation is fuel and energy. Those two are still uncomfortably high, and then the overall inflation is still uncomfortably high. So while we are headed the right direction, it might be prudent to hold the rate steady at 18% just a little bit longer, so that we get to a point where we are comfortable that inflation is under control. The second key point is that early this year is the first time when investors have real returns. When I mean real returns is whereby, for example, the 91 T-bill rate is now above the inflation rate. Until last year, the inflation rate was high and returns were negative. I don't think they want to change that early on in the game. They might want to give it a little bit more time before they bring it down.